Let me tell you something most traders won't admit. The first $1,000 feels exciting. The first $5,000, that's different. Not because of the money, but because of what it does to you. When you're under $5,000, you're trading to prove something. You're trying to see if this works. You're chasing momentum. You're reacting emotionally. But somewhere around $20,000, your mindset shifts. And if it doesn't, you won't stay there long. Most beginners think hitting $20,000 is about skill. It's not. Plenty of traders touch $20,000, very few stay above it. That's where everything changes. Because once your account reaches that level, the game is no longer about making money. It's about protecting it. And protection requires a completely different personality. Let's break this down. When your account is small, losses feel small. You can recover quickly. You take risks more casually. You think, I'll make it back. But when you're managing $20,000, a 5% mistake is $1,000. It's expensive, and suddenly every decision feels heavier. Pressure increases. Expectations increase. Self-doubt increases. You start realizing something uncomfortable. You don't just need a strategy, you need emotional stability, because at that level, volatility feels different. Drawdowns feel different. Confidence swings harder. Let me explain why. When your account is small, you tolerate chaos. You can gamble a little. You can overtrade. You can survive bad habits. But at $20,000, bad habits scale. And scaled bad habits destroy accounts faster. Here's what really changes. Risk becomes real. Not theoretical. Real. You start calculating differently. Instead of asking, how much can I make? You ask, how much am I risking? That shift is maturity, and most traders aren't prepared for it. Another thing changes at $20,000. Your emotional reaction to losses. When you lose $100, you shrug it off. When you lose $1,000 in one session, you feel it. Not just financially, psychologically, and that's when discipline gets tested at a higher level. Because now fear creeps in. You hesitate on good setups. You exit early. You second guess your plan. The irony? The more money you have, the harder it becomes to stay aggressive. And if you don't adapt, you either become too cautious or too reckless. Both are dangerous. This is why many traders grow to $20,000, then fall back to 12,000 or 10,000 or worse, because they didn't upgrade their mindset when their capital upgraded. Growth requires identity change. You can't manage $20,000 with a $2,000 mindset. Let me say that again clearly. You cannot manage $20,000 with the psychology you had at 2000. At lower levels, you think in terms of opportunity. At higher levels, you think in terms of exposure. Exposure to risk, exposure to volatility, exposure to mistakes. And here's something nobody tells you. The higher your account grows, the more boring you must become. Yes, boring. Less impulsive, less reactive, less emotional. Consistency becomes more important than excitement. You stop chasing big wins. You focus on steady execution. Because one oversized mistake at $20,000 can erase weeks of disciplined trading. Now let's talk about confidence. At small levels, confidence is fragile. It depends on wins. At higher levels, confidence must come from process. If your confidence still depends on green days, scaling will break you. Real confidence at $20,000 looks calm. It looks controlled. It looks patient, not loud, not dramatic. Calm. Another shift happens here. You start thinking long term. Instead of, how do I double this account? You stop dreaming about quick flips. You start building systems. Systems for risk. Systems for review. Professional behavior replaces emotional behavior. And that's the real transition, not the money. The mindset. Because $20,000 is not life-changing money in America, but it is identity-changing money for a trader. It forces you to decide who you are. Are you still the gambler who got lucky? Or are you becoming the operator who manages capital professionally? That decision determines whether you grow to $50,000 or fall back under $10,000. Now here's the uncomfortable truth. Some traders subconsciously sabotage themselves at this level because deep down they don't feel ready. They increase risk, they overtrade, they test limits, and when they drop back down, they say, the market changed. No, you changed. Pressure exposed you. This level exposes everything. Your discipline, your emotional control, your consistency, your patience, and if you're not internally upgraded, the market forces the lesson expensively. This is where everything changes. Not because $20,000 is magical, but because responsibility increases. And responsibility requires maturity. In the next part, we're going to talk about what separates traders who stabilize above $20,000 from those who constantly cycle up and down. Because the difference is subtle, but once you understand it, you'll never look at account growth the same way again. Good. Now we go deeper. Because getting to $20,000 is one thing. Staying above it is something completely different. Here's what most traders don't expect. When your account grows, your fear grows with it. At $2,000, you're aggressive because you feel like you have nothing to lose. At $20,000, you start thinking about what that money represents. Months of effort, late mornings, stress, mistakes, progress. Now it feels real. And when something feels real, you become protective. Protection is good, but fear disguised as protection is dangerous. This is where traders split into two categories. The first type becomes overly cautious. They cut winners too early. They reduce size too much. They start trading scared. The second type does the opposite. They think, I made it this far, let's push harder. They convince themselves they figured it out. Both reactions come from the same place, emotion. And at $20,000, emotion gets amplified. Let's talk about scaling properly. When your account grows, your risk per trade should stay consistent in percentage terms. If you risked 1% at $5,000, you risk 1% at $20,000. The dollar amount increases naturally. You don't jump from risking 1% to 5% just because you feel confident. That's how accounts collapse. Professional traders understand this. They let size increase gradually through math, not emotion. Another shift happens at $20,000. You start thinking about consistency over months instead of days. Small accounts chase big days. Larger accounts respect steady months. This is where patience becomes powerful. You no longer need to double the account quickly. You need to protect the base. Because once you have a base, compounding in practical terms. If you grow $20,000 at 5% per month consistently, that's $1,000 a month. Sustain that for a year. Now you're building something real. But that only works if you avoid big drawdowns. A 30% drawdown at $20,000 is devastating psychologically. It's not just numbers, it's lost confidence, lost momentum, and rebuilding from that takes time. Which brings me to something critical. Drawdown control is more important than profit maximization at this stage. You must think in terms of damage prevention. If your maximum acceptable monthly drawdown is 6-8%, you protect that boundary aggressively. Once you break it, you reduce size, not increase it. Reducing size during weakness is maturity. Increasing size during weakness is ego. Now let's talk about identity again. When you cross $20,000, you're no longer experimenting. You're operating, you're managing capital. Maybe it's your own, maybe one day it won't be, but you must treat it like it matters, because it does. You start asking different questions. Instead of, what's the hot stock today? You ask, does this setup align with my system? How much can I make? You ask, what's the downside risk? Instead of, how do I win big? You ask, how do I avoid big mistakes? This shift is subtle, but powerful. The higher your account grows, the more boring your trading style becomes. You don't need excitement, you need reliability. You stop chasing volatile junk stocks. You prefer cleaner structures. Better liquidity, defined risk. You care about execution quality, not adrenaline. Because adrenaline costs money at scale. Another thing that changes at $20,000 is your relationship with time. You stop forcing daily trades. You understand that capital preservation today gives you opportunity tomorrow. You become selective. And selectivity is edge. Let's talk about emotional stability at this level. If you still feel intense highs on green days and intense lows on red days, you're not ready to scale. Emotional neutrality is power. You win. You log it, you move on. No drama, no revenge, no overconfidence. That emotional neutrality keeps your equity curve smooth. Now imagine two traders both reach $20,000. Trader A keeps chasing big gains, risking 4 or 5% per trade. Trader B sticks to 1% risk, takes fewer trades, focuses on quality. After 6 months, Trader A has experienced wild sway, ings up to $28,000, down to $14,000. Emotionally exhausted, Trader B grows slowly, $20,000 to $24,000 to $27,000. Calm, stable. Guess who lasts? Consistency beats intensity every time. At $20,000, you start understanding something clearly. This is no longer about proving you can trade. It's about proving you can manage yourself, because larger capital magnifies every weakness. If you overtrade at $2,000, it's annoying. If you overtrade at $20,000, it's destructive. If you revenge trade at $2,000, it's a lesson. If you revenge trade at $20,000, it's a setback. Scale magnifies behavior. Good behavior collapses faster. That's why everything changes. Now let's talk about future vision. When you hit $20,000, you have a choice. You can treat it as a milestone. If you see it as a milestone, you celebrate. If you see it as a foundation, you build. And builders think differently. They focus on structure. They refine systems. They improve journaling. They review performance weekly. They think like operators, not gamblers. Another critical shift: you stop talking about trading as much. You start doing it quietly. You don't need validation. You don't need to show screenshots. You're focused on sustainability, because sustainability is the real flex. Flashy wins are temporary. Stable growth is rare, and rare is valuable. Let me be direct. If you can stabilize above $20,000 for 6 months with controlled drawdowns, you're closer to professionalism than most retail traders. Because most traders cycle up, down, up. Emotion-driven volatility, breaking that cycle requires discipline most people don't want to build. But if you do build it, the game changes again. Now you're thinking about $50,000. But not in a desperate way. In a structured way, you understand the path, protect capital, execute consistently, compound patiently. That's it. No say. CRET indicator. No magic strategy. Just discipline scaled with size. So yes, everything changes after $20,000 in trading. Not because the number is magical, but because the responsibility is heavier. The expectations are higher. The consequences are larger, and your identity must evolve. If you evolve with your account, you grow. If you stay the same while your capital grows, the market corrects you. Every time. So when you reach that level, don't celebrate too hard. Upgrade your mindset. Tighten your rules. Refine your process, because the traders who survive above $20,000 aren't the most talented. They're the most controlled. And control is what separates temporary success from long-term growth. And here's the part nobody really talks about. After $20,000, the pressure becomes internal. Before that level, the pressure is external. You want to grow. You want to prove something. You want to reach a milestone. But once you're there, now you're trying not to lose it. That shift from chasing to protecting changes your psychology completely. A normal red day doesn't just feel like a red day anymore. It feels like a crack in something you built. And that's dangerous if you don't handle it correctly. Because when you trade from fear of losing progress, you stop trading objectively. You hesitate on valid setups. You reduce size randomly. You break rules in subtle ways that don't look emotional but are. The market doesn't punish emotions immediately. It punishes inconsistency over time. And inconsistency at $20,000 compounds faster than it did at $5,000. Let's talk about decision weight. At $2,000, you click buy without overthinking too much. At $20,000, you pause. You double check. You feel the gravity of the position. That pause can be maturity, or it can be doubt. The difference, preparation. If you've built your process properly, that pause, E is discipline. If you've been winging it, that pause becomes hesitation. And hesitation kills good entries. Another shift that happens at this level is awareness of opportunity cost. You start realizing that every trade you take ties up capital. It's not just about whether it wins or loses. It's about whether it deserves your money. Low-quality trades become unacceptable. Because at scale, mediocre trades add up fast. This is where selectivity becomes your edge. You don't need 10 trades a week. You need the right trades. Quality over quantity becomes more than a phrase. It becomes survival strategy. Now let's talk about lifestyle expectations. Some traders think that once they hit 20 grand, things become easy. They imagine consistent withdrawals. They imagine smooth growth. Reality, it becomes more serious. You track performance more closely. You care about monthly statistics. You calculate risk-adjusted returns. You think like someone managing capital, not playing with it. And that seriousness is healthy, because trading is not entertainment. It's risk management with money attached. Another thing changes at $20,000. You start seeing the long-term potential. You realize that if you can maintain discipline here, scaling to $50,000 or $100,000 isn't fantasy. It's math. But math only works if volatility stays controlled. One reckless month can reset everything. That's why emotional spikes become your biggest enemy at this stage. Overconfidence after a hot streak, fear after a drawdown, impatience during slow markets. These emotions don't disappear with more money. They get louder. And you must get quieter. Quiet mind, clear execution, measured decisions. That's what stabilizes growth. Let me explain something subtle but powerful. At lower account sizes, your focus is on trades. At higher account sizes, your focus shifts to performance metrics. Win rate, average R multiple, draw due, 1%. Risk exposure, you start reviewing weekly instead of obsessing daily. You zoom out. Zooming out reduces emotional intensity, and reduced emotional intensity increases clarity. Another uncomfortable truth. If you're still emotionally attached to every trade outcome at $20,000, scaling higher will hurt you, because scale magnifies sensitivity. Imagine reacting emotionally to every 1% fluctuation. That instability becomes exhausting. Long-term traders build emotional insulation. They expect randomness. Without drama, this is where professionalism begins. Professionalism isn't about having a big account. It's about stable behavior regardless of account size. Now let's talk about compounding discipline. If you consistently protect capital at $20,000, confidence builds quietly, not hype confidence. Process confidence, you trust your system because you've tested it. You trust your risk because it's consistent. You trust your reactions because they're controlled. That trust removes hesitation, and when hesitation disappears, execution sharpens. Sharp execution increases efficiency. Efficiency improves long-term returns. It's all connected. Everything changes because the stakes feel real. And real stakes demand real discipline. Here's another shift. You stop fantasizing about big wins. You start appreciating small, clean gains. You understand that steady growth beats emotional spikes. You stop trying to impress anyone. You're building something. Quietly, and that quiet focus separates you from most retail traders. Let's talk about setbacks at this level. They still happen. You might drop from $20,000 to $17,000. The question is how you respond. Do you panic? Do you try to recover aggressively? Or do you tighten risk and stabilize? That response defines your future growth. Because a coup, NTS don't collapse from one loss. They collapse from emotional reaction to losses. Control the reaction, you control survival. And survival is the first rule of growth. Your vision extends beyond the next trade. You start thinking in quarters, in years. You begin understanding that longevity is the ultimate goal. A trader who survives 5 years with steady growth is rare. Most burn out emotionally or financially. Avoiding burnout requires structure outside trading too. Healthy routines, clear boundaries, defined trading hours. You stop letting trading consume your identity, because obsession leads to emotional volatility. Balance creates stability, and stability supports performance. Now let's bring this full circle. Why does everything change after $20,000 in trading? Because that's the level where you either evolve or expose yourself. It's the level where discipline matters more than ambition, where risk management matters more than strategy tweaks, where emotional control matters more than prediction accuracy. And if you upgrade your mindset with your capital, you unlock sustainable growth. But if you don't, the market will quietly take back what you weren't ready to manage. The number itself isn't magical. The responsibility is, the expectations are. The psychological weight is, that's what changes. So if you're approaching $20,000, or you're already there, understand this clearly. Slow down, tighten up, refine your rules, focus on protection, because once you master stability at that level, growth becomes predictable, not dramatic, not explosive. Predictable growth is the real sign that you've moved from retail thinking to professional behavior. Everything changes after $20,000 in trading, not because you made it, but because now you have something real to lose. And how you protect it determines how far you go. Next,